believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. By the way, to save your listeners a bunch of reading, the plan is that Newmont, after the Newcrest acquisition, will sell basically all of their Tier 2 assets. They operate too many mines now, and their management time and attention and their sustaining capital budget is split between too many competing mouths. The idea that they would take advantage of a very buoyant property market, which we're in right now, to sell the Tier 2 assets, use the cash to pay down their debt, and focus management, love, time, and attention, and also sustaining capital on 5 or 6 assets that matter, is a really good plan. But they have to do it. If they are successful in doing that, of course, the gross ounces that they produce will fall. That will happen. But the margins will expand. And the all-in sustaining capital costs will fall. The other thing that your listeners need to understand that is very difficult to understand is that the returns on capital employed in optimization are often double or triple the overall returns on capital employed in an operation. If a mine is put in production with an ROCE in the feasibility study of 20 or 25%, that's one thing. But after the mine is in production, when you're making smaller investments in optimization, retooling a mill, increasing the size of the haul trucks, increasing the size and efficiency of the shovels, return on capital employed in optimization can be 50%, 60%, 100%. Two, big mines are almost always put into production when there is enough reserve and resource to amortize the upfront capital expense. But those mines, in every case I'm aware of, deliver upside exploration surprises after near mine exploration commences, which is to say a mine with a 12-year mine life often produces for 18 years or 20 years. I look forward to Newmont benefiting from selling their Tier 2 deposits, improving their balance sheet, focusing their love, care, and attention on optimization, and expanding the mine lives in their Tier 1 operations. That plan will work if they implement it. It will be up to your listeners in terms of how their own portfolios do to monitor Newmont and Barrick's adherence to their plans.
In today's news recap, is now a good time to invest in silver? Investing in silver is a riskier play compared to gold, but there are reasons to believe that it could be a good time to buy the devil's metal. Alongside bonds, one way of diversifying a portfolio away from equities is through commodities. Gold has enjoyed a strong year, but there are reasons why now could be a good time to invest in silver. Silver prices have increased slightly over 19.9% in dollar terms over the past 12 months and 20.3% in sterling terms. Silver lags gold during this period, but given that gold and silver prices have historically been compared in order to assess the investment appeal of either, this arguably strengthens the case for investing in silver. Since hitting a peak in late October, silver prices have fallen approximately 10.4% in dollar terms and 8.2% in sterling over the past month. This could present a buying opportunity, but there are several factors to consider when deciding whether or not to invest in silver. The investment case for silver is distinct from gold. While it is similarly a precious metal with a rich history of usage in coinage, in the modern era, it is silver's industrial qualities that have the greatest bearing on its price. 55% of annual demand for silver comes from industry or tech, compared to less than 10% for gold. Adrian Ash, director of research at Bullion Vault, tells MoneyWeek, "Look around you. If something's got an on-off switch, it most likely contains silver." Other industrial use cases include brazing and alloys, the chemicals industry, and medical equipment. The latter benefiting from the fact that bacteria cannot grow on silver, an inert noble metal. For these reasons, silver sometimes tracks action in copper prices more than the safe haven precious metal. All of that said, many of the same drivers that impact the gold price, financial stress, interest rates, inflation expectations, and policy decisions, also apply to silver. Indeed, you can think of silver as gold on crack, says Ash. More irrational, more volatile, more dangerous, but also more fun if you're looking for risk. Now we'll show you more clips, but first, check our Black Friday deal in the pinned comment. If you're a stacker, make sure you're keeping all your data private and that you're browsing investing-related stuff in a safe manner. With NordVPN, you'll be sure that your privacy is never exposed. Take advantage of the limited time offer now, and let's get back into the episode.
Nope. Nope. I'm a credit guy. I love, I think the worst piece of debt is better than the best piece of equity on any individual balance sheet. But I don't like the direction of interest rates, and I don't like duration. I own, relative to most people, a lot of U.S. Treasuries, and I don't own a duration longer than 2 years. The interest rate curve between the short and the long is stupidly disproportionate in terms of risk. And the part of the credit market that I've specialized in most of my life, which is below investment grade, is insanely overpriced. People have chased yield without any understanding of the covenants and conditions on the bonds that have been issued. Wall Street has unleashed a torrent, trillions of dollars of debt that is junk debt in the truest sense of the word. I remember the junk debt market, the below investment debt market in Canadian oil and gas companies in 1988, 1989, 1990, 1991. You could buy bonds with a cover yield of 12% that was being earned, and you could buy those bonds, 4 or 5 year bonds, at 60% of par, which meant that you had an 18% running yield and a 25% yield to maturity. And the bonds were covered by net present value in the first instance and by free cash flow in the other circumstance. You don't see that in the high yield market anymore. You don't see it in a market that I'm familiar with. I would point out something else to you, Jesse. The credit market, the yield market, is driven by a desperation for yield. And I think that yields are actually negative. People who buy bonds believe that a deterioration of the purchasing power of the US dollar is a function of the CPI, which is to say the bogey is 2.6%. I think the CPI understates the deterioration of the purchasing power of the US dollar substantially. When I look at the basket of goods and services that I buy, Jesse, I would suggest that the deterioration of purchasing power of the US dollar is more like 7.5%. I'm not somebody who thinks that the US dollar relative to other currencies is a bad currency. Our mutual friend Doug Casey says the US dollar is the worst currency in the world except all the others. But I'll tell you that the CPI as an index is stupid. It doesn't include tax, doesn't include food or fuel. I mean, any index that doesn't include lunch is of no use to me. So for me, my bogey's 7.5%. The idea that I'm going into a 5-year junk term at 6.5%, which suggests that I'm losing 1% a year in purchasing power while taking real risk, is an insanity to me. As long as I'm on the tangent, Jesse, let me go a little further. The sector that scares me the most for retail investors is the high yield ETFs, the junk bond ETFs. There are trillions of dollars invested in these things by people who don't know what a bond covenant is. They look at the disparity in the yield on the ETF between that and the deposit yield that they get at their major bank, which doesn't pay them interest. And greed drives them into the ETF. Now, the Topco, the ETF, is extremely liquid. They trade billions of dollars a day. But the constituents of the ETF, the over-the-counter traded junk bonds, are extremely illiquid. If the American investor began, say like in 2008, to begin to be concerned about credit quality and sold the ETF, the managers of an extremely liquid instrument would have to sell the underlying instruments to satisfy the redemptions. To who? You may have heard me refer to those illiquid bonds as owl bonds. An owl bond is a bond where you call your broker and ask him or her to sell it, and they say, to who? To who? The idea that we would have disintermediation from the ETFs into a market where there's no bid is equivalent to a bank run with no treasury backstop.
What do you think about Rick Rule's long-term bullish stance? Do you agree with his assessment of gold and silver as essential stores of value in these uncertain times? Share your thoughts in the comments below. We'd love to hear your perspective. Now watch this video right here because you'll love it. I'll see you on the other side.